There's an investment strategy that is as simple as it is effective, and it involves only 3 funds. So let's talk about the Bogleheads 3-fund portfolio. So before I started to invest, I procrastinated for years. And that is because I thought I had to learn complicated stock analysis, read annual reports from companies, and basically make a degree in finance so that I can pick the right single stocks. But then I discovered index funds, and suddenly everything became much easier. And that is exactly what this 3-fund portfolio is based on. So let's talk about how exactly this 3-fund portfolio looks like, why it works, and also who it's for. Now, before I dive into the specific funds, let me give you some context. Index funds in general are several different single stocks bundled together in a fund. But then it's not just any single stocks, but the single stocks that represent a certain market. And these index funds actually go back to the founder of Vanguard. His name's Jack Bogle, and he's often called the father of index funds. That's because he created the first one within Vanguard, and this may sound familiar, because the first one was an index fund bundling together the companies, so the single stocks, from the companies from the S&P 500. And his philosophy, so Jack Bogle's philosophy was that instead of trying to beat the market by trying to pick the best single stocks, why not just own the whole market? And that was the reason he built these funds, index funds. What that means for us private investors is that we do not have to choose companies. We just buy all of them. And the best thing about it, he also made those investments, those index funds, very cheap. And this idea of index funds became very popular, especially within a group of investors, beginner investors and professional ones, who also believed in keeping investing simple, low cost and effective based on the ideas from Jack Bogle. And this is why this group of investors calls themselves the Bogleheads. The goal of this investment strategy is long-term growth, so we're not looking for the quick buck, low fees because high fees can really empty the pocket of us private investors, and diversification, which simply means to not put all of your eggs into one basket, for example into the basket of one single stock, but instead spread over different baskets, and by that we lower our risk. Alright, now let's look at the 3 funds. The first one is domestic stock market, the second one is international stock market, and the third one is bonds, domestic bonds, maybe. Now, because Jack Bogle was US based, Vanguard is too, and I presume that a large part of the Bogleheads community is as well. The classic example for a 3-fund portfolio like this would be a US total stock market index funds for the domestic total stocks part, then an international stock market index fund for the international stock market, and a US total bond market for the bonds, for the domestic bonds. Vanguard examples would be VTSAX, VTIAX, and VBTLX. Now, in a way, this does make sense because the US is the strongest economy in the world. Now, if you do not live in the US and or you do not believe in the US economy in the long term, then you could also choose another country for the domestic stock market and also for domestic bonds. Now, I'd personally say the smaller the economy, the less that makes sense because it's increasing the risk. And by the way, this tendency to buy stocks from your home country is actually called the home bias. And it's called a bias for a reason, you know? And it also potentially diminishes your returns. But then also the beauty of this 3-fund version is that you get to decide how much you want to put into each part. What you could do, for example, is choose to put 20% in bonds and then 80% in stocks, and the 80% stocks part divided between the two, domestic stock market and international stock market. Now, I guess a classical choice would be 60% in domestic stock market, 20% in international stock market, and then the 20% in bonds. For me personally, that would be too much of a US exposure, but that is something that you have to decide yourself. But you could also switch it, right? You could go for 60% international stocks and 20% US stocks, or you go for 40% and 40%. If you want to keep it a little bit safer, you could go for 30% bonds and 70% stocks, or even 40% bonds and 60% stocks. So there's so many different options to put together this 3-fund portfolio so that it exactly fits your needs, which I think is really the brilliant part about it. Before I continue with why this strategy works, just real quick, I'm hosting a free web class about financial freedom where I share all the strategies that I used to put myself on the path to financial freedom. If you're interested in that, I'll link it down below where you can save your spot. And now let's continue with why this 3-fund strategy works. The strategy is so effective because we have a stocks part that is for growth. We have the bonds part that at the same time keeps the stability of this portfolio. And because we're only using index funds, we have a diversification that spreads the risk over many different companies and also between the two main asset classes, stocks and bonds, right? And at the same time, it's so simple because we only have 3. And like we already talked about, you can change the proportion between those 3 funds anytime. So if you decide to make it safer, put in more bonds. If you decide to make it riskier for the return, you put in more stocks. But not just that, the strategy is also evidence-based. So there have been decades of research that show that asset allocation is how much you put into different assets. So in our example here, how much you put into bonds and how much you put into stocks. And the research showed that this asset allocation is actually much more important for how our money performs than which single stocks we choose or the market timing when we decide to buy it. Isn't that crazy? And the other evidence-based part is that most active investors, so the ones that try to pick single stocks and try to time them right, and this may be institutional, like professional fund managers, or this may be private investors like us. The majority of those people, those active investors, they underperform the market in the long term, which means they have worse results with single stocks compared to index funds when we look at the long term. And that is exactly the reason why my main investment strategy is also to put money into index funds. All right, now who is the 3-fund portfolio for? I would say it's for beginners who want a very easy strategy that is safe but also effective and performing at the same time. Now I'm saying safe because the wide diversification is lowering the risk like tremendously, especially when we compare that to single stocks. But of course that doesn't mean it's a safe investment in the sense of it's the same safe as cash, for example, because as you will already know, the stock market goes up and down all the time. So there may come times where your investments go down and then you see red numbers. But if you just hold on to the investment long enough, then it will go up again. So just saying, safe investment here is relative. All right, but it's definitely not just for beginners. It's also if you're already a professional investor, like within the context of you being a private investor. Because if you're working a full-time job and you don't want to spend the time of researching 100 different ETFs or index funds to invest in, then this is a great option because it's a set it and forget it strategy. You don't have to adjust anything except maybe once a year, checking the proportion, like the asset allocation of your 3 funds, and then check if it's still what you want. Now, with that being said, I personally do not have a 3-fund portfolio. I'd say mine is a little more complex. But then again, I'm a finfluencer, a financial influencer. So I guess this kind of comes naturally. But also, I do not invest in bonds yet. I have a high risk tolerance, which means those stock prices jumping up and down, this doesn't bother me at all. And I also want to maximize compound interest and, take advantage of that higher potential return that comes with the higher risk of stocks. So yeah, that's why I do not invest in bonds. Theoretically, you could do that with a 3-fund portfolio, just then the bonds part of the portfolio would go to 0, and then technically it's a 2-fund portfolio. Anyway, if you want the details of how I invest my money, I'll link a video for you here. Thank you for watching. I hope you got some value out of this, and I'll see you in the next video. Bye-bye.